The following podcast is brought to you by iSelect Fund. iSelect is dedicated to helping investors create a diversified portfolio of venture investments through their financial advisors. Learn how to start your own venture portfolio today by visiting iselectfund.com. Welcome to the very first episode of the Innovation Anarchy podcast. Each week, we plan to bring you ideas on investing, innovation, technology, and entrepreneurship. This week, we discuss the Jobs Act, crowdfunding, and the world of venture capital, and how they came together in the creation of iSelect.
It's Carter Williams
and Mike Kime,
and we lead the iSelect team. And we often get the question, how did you come up with iSelect? What was the idea behind it? So we thought it would be good idea to explain our thinking behind iSelect and how the idea came together in a podcast format, so you could get a better idea. And so, Mike, why don't you start off with how this all came together originally?
So, Carter, I started working on the concept of iSelect the same day that Obama signed the Jobs Act into law. And I don't know if everyone knows what the Jobs Act did or what it has done, but basically what it did was remove years and years of laws that said that people couldn't publicly solicit or advertise any private offerings. And the reason I became concerned, and the reason we started iSelect, is that we were concerned that being able to advertise private placements without a solid base of diligence and without a sound investment strategy behind it would cause people to lose money. It would create potential fraud in the marketplace, and it would ultimately hurt all of the good actors out there that were really working hard to build entrepreneurial ecosystems and to grow their communities with that as the base of growth. And we had seen that happen in St. Louis, and we've seen it happen over the past 25 years, where organizations like the Danforth Center and the Biogenerator and the Cortex District and other areas have grown up around the entrepreneurial community that we have here in St. Louis. And we've got real growth. If you look out our window from our office, there's $2 billion of investment in real estate occurring that's being driven because companies that have grown up through this research and development and entrepreneurial ecosystem now need a place to operate. And they've grown and they've matured, and these companies are spending real money hiring people, driving the economy in St. Louis and in other other places like St. Louis across America. And we felt like if you were going to continue that you needed to provide a way for people to get into this asset class in a responsible way. And that meant having a solid base of due diligence and being able to diversify and know that their money was going to be managed in a responsible way in an ongoing.
So iSelect often talks about the importance of diligence. And when we know it's called the Jobs Act, but a lot of people call it crowdfunding. And I think some of people, when they hear crowdfunding, they think I go to some website, I can find all these companies, and I can invest $1,000 or $5,000 in them, and I'm gonna do really well. There's just this it's just all internet enabled. But you talk about diligence. I mean, is it that you're not getting it, that it should all be website based, or is there something about the perception of what crowdfunding is versus what is appropriate?
So one of the things you see with crowdfunding is that there's a limit. There tends to be an upper limit on the amount of money that people are willing to invest, because there's a very limited number of people in the general audience of investors who are going to go click on a website and invest in a company that doesn't have a full diligence backbone behind it. And so what I mean by diligence is, it's easy to create an advertising piece or a marketing piece that has a lot of puffery and talks about the great things that a company can or could do. But you've got to back that up with solid documentation that says the management team on this company has the capacity to lead the company into the future, that they have the background and the knowledge and the integrity that it takes to be successful in this business. that they own the intellectual property that they say that they own, and that there's not other claims to it, and there's not the risk that your core asset could be taken away from you in a technology company. That the investors that have invested in the past have been given the right disclosure materials, and the investments have been done properly, so that you're not at risk of having a securities lawsuit when something doesn't go the way those investors expected it to happen. And so that was what concerned me when I started iSelect, is that none of the crowdfunding sites give their investors that type of comfort. They don't give them that access to that information. And so I spent 2 years before we ever went into any distribution or took any companies on, building a diligence backbone that went out and asked all those questions, made the companies provide us the information, but then almost more importantly, made it available to every investor and every person who invests through our system, whether it's a financial advisor or their clients, to be able to come and look at the materials themselves and see that we really have done this level of diligence and the company's really doing what it says it's supposed to do. And that level, that access to information, I think is key to one of the distinctions between us and a crowdfunding platform, is because we provide that level of diligence, because we do that level of investigation. Our product can be distributed through financial advisors who operate in a highly regulated environment. And that's where the majority of the capital in America is that's not being deployed into these assets. That's where the biggest area to go and drive real growth in our economy is by giving the people who rely on their financial advisors, who want to have a diversified portfolio that's properly constructed, and who don't have the time to go and do the diligence and look at these companies themselves, but understand that's a necessity to being able to invest responsibly. If we can give those people access to early stage investments, we can drive real money into the companies, provide those investors a responsible investment vehicle, and continue that growth that we've seen happening in St. Louis over the past 20 years.
So we tell this story often, but we'll repeat some of the numbers. In the 50s and the 60s, the U.S. saw a lot of growth in every single city because there were available capital from local banks, and a whole bunch of different industries were able to grow. As the world changed for various reasons, it seems like we really think of Silicon Valley as the place where we see innovation. But by our analysis that we've done inside iSelect, we think that in other places other than Silicon Valley, that there's a shortfall on the scale of more than $8 billion a year of investment opportunity, whether that's in healthcare or agriculture or other areas. So when the Jobs Act came out, there was this notion that people couldn't go get on a website and go buy companies. But to some degree, the Jobs Act was about creating jobs. It wasn't about crowdfunding. And so creating jobs is really about closing the gap on the $8 billion, not about $50,000 here or $100,000 there. And $8 billion is a big number. It's bigger than a couple $100,000, and so driving scale ends up being a pretty important thing.
Well, and Carter, this is something that was so enlightening to me when we came together and started working on this concept, because I brought a view to this of really trying to protect my own backyard and looking out my window and my career and seeing what we had done and being worried that it was going to be destroyed right here in St. Louis. And you really brought the perspective of, yes, there is this issue in St. Louis, but the same issue persists in Minneapolis and Memphis and Kansas City and Denver, and it goes across the country, that there is a lot of built-in expertise and a lot of need to address real problems that people are facing in their daily lives or that businesses are facing. And so there's a real opportunity to provide technology, to provide services, to provide businesses that address those problems, but there's a shortfall of capital to support these entrepreneurs. And it's not a problem unique to St. Louis or any other municipality. It's a big issue, and that you have to think globally and largely about it. And that was what I hadn't brought to the table when we were thinking about this, and the fact that we can scale this diligence platform and this program in a way. And that's why, and I think that your concept and your background in lean manufacturing and the efficiency you've driven to our process has really enabled us to take on the problem on a much larger level.
Yeah, so building on that a bit, my background, well, when people think about venture, they think about John Doerr or Mark Andreessen or somebody is this brilliant venture capitalist who's able to sort of perceive an opportunity and happens to make the investment and it gets really big and it's successful. Well, there are only so many of those people, and let's say it's true that they have that kind of perceptive capability. There are only so many of those people, and if we've got to drive the economy, we need more growth, and growth comes from a lot more entrepreneurs, and there's an $8 billion shortfall. The question, as I saw what we were doing here, is how do we make it bigger? And an advantage I had in my career, sort of to complement your experience with securities, is I started my career in manufacturing in 1990 before anybody knew what Lean Six Sigma was, and we were in the aircraft business and we had high defect rates, and we had a business that was really about crafting the assembly line, and a whole bunch of people involved in twisting and turning, and it was a very labor intensive process to make aircraft well. And learning from how Toyota in the 70s sort of changed their approach to manufacturing and application of lean manufacturing, the grabbing statistics and data from the shop floor and drawing that up into the decision-making process and using that to build better vehicles with a higher quality and scale allowed Toyota to grow rapidly and dominate over GM in as short as 20 years. We did that in aircraft and dramatically shifted the cost curve in how we built aircraft. And at the time, nobody thought we could build those systems more effectively. But the application of data and statistics and discipline allowed us to build a better product. Building on that a bit, the next phase of my career was managing R&D at Boeing. And we had, at that point, most venture capitalists invest 20, 30, 40, $50 million a year. At Boeing, we were investing in R&D in all of our different kinds of projects. We were investing as much as $300 million a year in 4,000 different research projects. And so when venture capitalists think about, I'm going to do 10 deals a year, we were thinking about doing 4,000 projects a year, which is a totally different scale. And we learned sort of two things. One, we applied the same practices we did in manufacturing. It's let's bring process and tools and discipline towards the decision-making process. We also learned from Merck. So Merck in the 80s, trying to improve their research and development process, it used to be there was a chief scientist. He sort of perceived how the world would be. He would pick what drugs they would do. And they really switched the mindset that said, no, we're going to invest in a whole bunch of little projects. We'll see which ones emerge as better options to cure cancer or a virus, and then we'll double down on those and grow them. And a lesson I learned at Boeing was we dramatically increased the return on our portfolio by broadening our base of research, doing a lot more small projects, not trying to guess ahead of time as to whether they'd be successful, but apply discipline. Discipline a lot like how you do diligence. To be sure that the projects were well formed, that they had a good team, they were going after a big market. But we didn't guess whether they were perfect people, and we really wanted to have projects that had meaning. If they succeeded, they would be important. Fund them to a level. And then of the thousands of projects we funded, a few would really emerge as the strong ones, and that Boeing would protect its interest in the long run based off the ones that emerged. And that's currently how Boeing's growing, is based off of that.
So looking back at that, when you look at the technologies that and this is a little bit aside from our discussion here, but just when you look at the technologies that you work with at Boeing, are you able to look now out into the world and see those things maturing and making a difference both in Boeing's return for their shareholders and just in the core mission of what they're doing too?
Yes, and we today I've had the advantage of I sort of consider this sort of sending kids to junior kindergarten and seeing them graduate. You send a bunch of kids, you go to kindergarten with a bunch of kids, and you say, well, that kid's going to get into Harvard, and that kid's going to go to community college. And then you run forward 14 or 15 years or 17 years or whatever it is, and now you find out that you were wrong. The kid that you thought would never make it is first in his class heading off to Harvard, and the other kid is in prison or something. It varies, but the hubris of thinking up front that you know the answer is hubris. So that's one lesson. The other thing you learn is some kids are going to go to college. You don't know which ones, but you know if you send a certain amount of them into JK, there are going to be a certain amount that go to college, and it's a pretty consistent pattern in terms of the volume. And Boeing's business has changed a lot. That at the time we were thinking that there was going to be a lot of manned aircraft, and now there are a lot of unmanned aircraft. And Boeing hasn't gone out of business, but we placed enough bets in enough different locations that as the market sort of shifted, and we didn't know 9/11 was coming along, but we had built the research in case it did. We sort of covered all of our bases against a bunch of different futures. And the reality is that we had to. It's not like we could wake up one day at Boeing and say, "Oh, we didn't know 9/11 was going to come along," and "Oh, I'm sorry, the company went bankrupt." Forgive us.
So with all of that background and that your experience, you understanding the platform that we've built to date, when you see iSelect becoming fully actualized and being able to grow to the size and scope that it really could get to, what's your vision there? How do you see how much capital being deployed a year, how many companies, and what's your ultimate vision for seeing this thing?
So based on my experience in Boeing, and we were deploying $300 million a year on a lot of projects, I absolutely think that the right place for iSelect to be is the principal capital provider across the Midwest and deploying on the order of $300 to $400 million a year into early stage ventures. It is now sometimes when I say that to a traditional VC, it's sort of like walking to the mechanic on the shop floor in 1990 and saying, this aircraft that currently has a 10% defect rate is going to have a 1% defect rate. He just looks at you like you landed from Mars, and it's not possible. But I'll say that my lesson from that and the guidance from your skill and diligence in bringing that perspective forward is that provides the discipline that makes it possible to do $400 million a year. That the concept of portfolio theory that was first really actually proven out by a bunch of people at MIT and Harvard in the early 70s, reduced into practice at Merck in their research, continued in research with our work at Boeing, has been applied broadly, is that investing in a lot of little projects and knowing that a certain amount of them will succeed and a certain amount of them will fail is good portfolio theory and is good investment strategy and can provide you with a good return on your investment that's better than the public markets. That we have all the underpinnings of process that allow us to make these investments without having the utter single most insightful visionary on our platform. We almost don't need to be a visionary.
And I agree with you, and I agree with you. I'm going to just tell you one thing I believe, too. I think that one of the big reasons why traditional venture capital hasn't focused on driving this type of efficiency into their organizations is because they've grown up and the industry's matured in a way that a lot of venture capital firms are making more money on the management fees that they charge than they are on driving real return to their investors, too. Do you agree, or do you think there's any...
Yes, I think that they make a lot of money on their management fees. The management fees are nice. If you've got a $200 million fund and you're getting paid 2.5% per year off of that fund, a lot of people can send a lot of kids to private school on that. ERISA and such have sort of motivated pension funds to invest in venture. When you really look at venture, it's really only the top 10% 5% of the funds that deliver the majority of the gain, and the other funds don't quite perform so well. So in the personality-led funds, they're doing an okay job. But then really you start getting into fees and structure and where are they investing, and are they just investing in Silicon Valley, and where are the other opportunities? And with IS Select, what we can do is we can create that portfolio diversification. We can do it in places other than Silicon Valley where there's not as much competition for deals, so we can get good prices. And we can do it, we can structure it in a way that provides our investors, institutionals, and financial advisors a return greater than they can get into the general market.
Yeah. You know, and you hit on another thing that really bothers me, has traditionally bothered me about venture capital, and it was one of the impetuses behind iSelect, and that's it's a very much an elitist club too. That even ordinary accredited investors, people with a net worth of say $2 to $30 million, and particularly those people living here in the Midwest, simply don't have the opportunity to invest in the venture capital funds that are out there. And so even for some of our highest net worth people, they don't have access to this.
They don't have
class.
access. That's correct.
And so what that's done is leave a giant source of financing for some of our most important businesses completely untapped. And I think that's what we're trying to do.
Well, that's certainly the contrast. If you go back to the 50s and the 60s, this country across the board, for a lot of reasons, grew nicely. It had a motivated workforce who came back from World War II and was ready to work. It had capital provided in the local communities, and it was diverse. It excelled in 60 different industries. Right now, we talk about our excellence in media and entertainment and IT based on Silicon Valley, but here in St. Louis, we have some of the best agricultural research institutions in the world that are developing things far superior to anywhere else. Animal health in Kansas City, logistics in Memphis, medical devices in Cleveland. These are all great centers of some of the best talent in the world. Every great startup needs access to talent. It needs access to capital. It needs access to customers. And in certain areas, those ratios and mixes are different. And so when we look at the economy and how to grow the economy, I really think it's right in front of us. We have the entrepreneurs available. They're just being held back. And the reason they've been held back is we've had this premise for years that the only people that can invest effectively are particularly skilled people called VCs in Silicon Valley. What Boeing and Merck teach us, and some new research out of the Kauffman Foundation teaches us, is that the true determinant to success in early stage ventures, the true determinant is the depth of diligence, diversification. Don't invest in one company, invest in 20. And make sure that you reasonably pay attention to the companies after you've invested, so that as they run into trouble and they're in JK, and now they're in first grade, and now they're in second grade and third grade, and they come home when their knees are skinned, or something's a little bit askew, that you're there to sort of, as an investor, you're there to sort of keep them on the right path and sort of keep pushing them with best practices, but let them lead. That diligence, diversification, and monitoring the deal afterwards are the three strongest correlations to success. That who the investor is or who the fund is didn't really determine outcome. It was almost between even diligence, diversification, and post-deal monitoring, diligence alone. And in our process, we call diligence a selection process. It's really a rejection process. It's a process of saying, this company's got some crooks involved. This company's going after a market that's too small. This company has a business plan that won't work in this business. And so you sort of push away the hundreds of companies that really just don't understand how that market works. And we've looked at how many? 800 companies, and we've invested in 20. It's not that we picked those 20 up front. It's really that we sort of peeled the onion back, and that's what was left inside after we pulled away. And what the Kaufman data has shown us most recently is that kind of consistent process will give you a portfolio that provides above average returns to investors. And we're talking about going to institutional investors and wealth managers who have access to as much as $10 trillion. So now you start to see how we can scale this. We can scale with process and diversification rather than personality. The capital's available. We can get the institutional capital if we do diligence. And you can start to see that it really is just a matter of execution to get to $400 million per year.
And the thing that I've grown into and realized from working with you is that it's true on a micro level and it's true on a macro level. That if we go in and we execute good diligence and we responsibly monitor our companies, then on a micro level, and we do that over and over and over again, it has a macro impact on our economy too.
Yes.
And one thing, we have a lot of political viewpoints that float around our office, and we have a lot of diversity of thought amongst our full team. But one thing that everybody absolutely agrees upon is that if we can drive this country to 4% growth of GDP, it eliminates a lot of social issues, it eliminates a lot of economic issues that people are fighting over today, and focuses the country on what's important. That's innovating and growing and giving people the opportunity to be better today than they were yesterday. And I think that's what the common goal at iSelect is ultimately, let's drive our economy to that point, and let's give people, everybody, the ability to participate in that growth and that economic opportunity.
Yes, and it's going to happen at two levels. One, when you're producing at 4% GDP, the tax base is stronger and it just pays revenues down. But then the other thing is somebody invents a way to cut the cost of diabetes treatment by 90%, or they figure out how to increase crop yield by 15%. And so that there are fundamental productivities that get inserted into the economy. So and frankly, that's what we saw in the 50s and the 60s, is it came from all different angles. And I was in a little bit of a debate with a Brooklyn economist about this the other day, where he couldn't figure out exactly where the savings were coming from and the opportunity, but it comes from the taxes on a 4% GDP, from the productivity of a new drug that reduces the cost of diabetes, and it comes from people going to work every day and being able to take care of the kids and everybody being happy and getting them into school and doing all the things necessary that this family life is organized and that they can enjoy themselves. And that's really what we strive for on a broad basis. What is important to me and to both of us is every day we wake up trying to make this process stronger, better, more effective, because as we do that, we can start talking about $100 million a year, $200 million a year, $400 million a year. Maybe we get to the point that we alone are doing $1 billion a year. It's a little, when we were doing Boeing doing $300 million a year, it felt like the guy with the spinning plates in a whole bunch of different directions. But I think the way technology's come on now, that it's sensible that we can sort of manage that kind of scale. So it's very exciting.
It is, and it's been a pleasure working with you. Enjoyed talking to you today.
Thank you for listening to us. We're both excited about what we're doing here at iSelect, and more to follow.
Thank you for listening to the very first episode of the Innovation Anarchy podcast. To subscribe, go to iTunes, Stitcher, or wherever you get your podcasts. Stay tuned for more conversations about venture, innovation, and entrepreneurship.